Indonesia's Rupiah hit record lows against the US dollar in early June 2026, breaching the 18,000 IDR USD level after trading near 17,669 earlier. The currency weakened too, 77% over the past month and 10.16% over the past 12 months. Since President Prabowo took office in October 2024, the Rupiah has depreciated by more than 14%, making it one of Asia's worst-performing currencies this year. This slide sets the scale and timing of the decline that the rest of the deck will explain. The central story of 2026 is straightforward. A severe oil price shock hit an Indonesian economy that was already exposed by structural, external, and fiscal vulnerabilities. Because Indonesia is a net oil importer, higher crude costs increased dollar demand and worsened the trade balance. At the same time, investor confidence weakened as capital outflows, policy uncertainty, and strong USD demand amplified the pressure. Policy actions have stabilized the currency temporarily, but they have not yet fully restored market confidence. The immediate trigger was the US-Israel conflict with Iran. Brent crude was trading around $72 per barrel on February 27, 2026. Before jumping to $79 on March 1, an 8% one-day move as markets reopened. Prices then accelerated to roughly $120 per barrel by March 9 and peaked near $138 in April amid Strait of Hormuz concerns. Even in June, oil remained elevated at $94 to $97 per barrel, leaving Brent more than 55% above pre-war levels. Higher oil prices hit Indonesia through three transmission channels. On the external side, they raised the import bill and increased demand for US dollars to pay for energy. Quantitatively, every $10 increase in Brent reduces Indonesia's trade balance by about 0.2% of GDP. On prices, every $10 Brent increase adds roughly 0.4 percentage points to headline CPI, and at $100 per barrel inflation could reach about 4.5%. Because domestic fuel prices were kept fixed, the energy subsidy bill widened, adding fiscal pressure on top of the currency impact. Indonesia's external position deteriorated rapidly in early 2026. The Q1 trade surplus fell to $7.98 billion, down from $13.07 billion in Q1 2025, and the monthly surplus collapsed from $3.3 billion in March to just $89 million in April. Oil and gas imports jumped 85.5% year-on-year in April, while non-oil and gas imports rose about 14% on domestic demand and manufacturing needs. On top of that, Q2 dividend payments, foreign debt servicing, and Ramadan-related import needs added further dollar demand. The current account moved from nearly balanced to clearly negative. The full year 2025 current account deficit was just $1.5 billion, or 0.1% of GDP, but in Q1 2026 it widened to $4.1 billion, or 1.1% of GDP. Bank Indonesia projects the full year 2026 deficit to land in a 0.5% to 1.3% of GDP range, with risks tilted to the higher end. A weaker external position like this makes the Rupiah more vulnerable to any shift in dollar demand or investor sentiment. The 2026 shock differed from the 2022 Russia-Ukraine episode in three important ways. First, the Strait of Hormuz threat raised the risk of a sustained oil supply disruption, with the strait handling about $17 billion of oil flows per day. Second, unlike 2022, Indonesia did not raise domestic fuel prices. RON 90 pertalite has remained fixed at IDR 10,000 per liter since September 2022, shifting the full subsidy burden to the government budget. Third, the economy was running hot, skewing inflation risks to the upside. In a sustained $100 per barrel scenario, the Rupiah could theoretically move toward 17,400 to 18,000 per dollar. Fiscal metrics added to the pressure on the currency. The 2025 budget deficit was 2.92% of GDP, or IDR 695.1 trillion, the widest since 2005 outside the pandemic years, while public debt stood at 46% of GDP, or Rp 9,637.9 trillion in December 2025. The 2026 deficit target was set at 2.68% of GDP, and 2024 energy subsidies already reached IDR 713.5 trillion, roughly 5% of GDP. President Prabowo's free school lunch program is estimated at $30 billion, and both Moody's and Fitch revised Indonesia's sovereign outlook to negative in February and March 2026, respectively. Capital outflows intensified the currency move. The Q1 2026 capital and financial account recorded a deficit of $4.925 billion, with January to March equity outflows of about Rupiah 26 trillion, or $1.58 billion, and government bond outflows of about Rupiah 25.1 trillion, or $1.52 billion. April brought another Rupiah 12.5 trillion of equity selling, and the May MSCI rebalancing triggered estimated passive outflows of $8 to $3 billion. Indonesian equities plunged nearly 5% to their lowest level in more than a year, and Indonesia's 5-year CDS moved above 80 basis points, signaling higher perceived risk. The external currency environment reinforced the pressure. The DXY hovered around 99.9 to 100.1 in early June 2026, with the dollar up about 2% over the past month, and the trade-weighted USD index against emerging market currencies rose to around 129.4. The Federal Reserve has held the federal funds rate at 3.50% to 3.75% through mid-2026, while strong U.S. jobs data and economic resilience reinforced USD strength. Crucially, the U.S. is a net oil exporter, and therefore more insulated from higher oil prices than Indonesia, deepening the divergence between the two currencies. Bank Indonesia responded on multiple fronts. It intervened heavily in the foreign exchange market, raised its lending rate to 5.25%, and then delivered an emergency surprise rate hike that took the policy rate to 5.5% in June 2026. The central bank also leaned on attractive SRBI yields to encourage portfolio inflows. These measures provided temporary relief, but they did not fully restore investor confidence, and analysts pointed to the need for deeper policy credibility and fiscal discipline to anchor a more durable recovery. To close, the Rupiah's decline was the product of a severe oil shock, weaker external balances, fiscal concerns, capital outflows, and broad USD strength acting together. Indonesia's status as a net oil importer made the energy shock especially damaging, and fixed domestic fuel prices shifted the burden to the budget and amplified fiscal pressure. Foreign selling and policy uncertainty amplified the currency move on top of those fundamentals. Temporary stabilization is achievable through intervention and higher rates, but durable recovery will depend on oil market relief, fiscal discipline, and restored investor confidence.